Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I will be your host for this week's topic, which is titled The Power of Leverage. Now, leverage is the ability to capture higher returns on your investments by employing less capital. And knowing how to take advantage of leverage is the surest way for your portfolio to meet its full potential. Now, there are several ways to employ the power of leverage, and the first one you may be familiar with is margin, where your broker allows you to borrow money and you can enhance your buying power and thereby leverage your account. Suppose you have $10,000 and you are looking to buy shares of XYZ stock and it's currently trading at $50 a share. Now, that would allow you to buy 200 shares of XYZ. Buying on margin, however, lets you borrow another $10,000 from your broker so you can buy a total of 400 shares, and now your total investment is $20,000. Now, margin rates and borrowing capabilities are specific to your broker, but this, just generally speaking, this is how a margin account would work, where you borrow money and you can buy more shares. But you have to remember, buying on margin is a double-edged sword that can cut both ways. So while it's nice to know that you're earning $2 every time the share price goes up 1, technically speaking, the converse is true. Every time the stock drops by $1, you also lose $2. And even worse, if that stock price comes crashing down, you get that dreaded margin call, and you will be forced to sell the stock once you no longer meet the margin requirements with your broker. So buying on margin is a dangerous way to gain leverage, especially when the underlying stock is very volatile. A better strategy would be to buy call options instead. So let's take a few minutes and talk about the process of buying calls. First of all, what are the objectives if I buy a call option? Well, number one is to use it as an alternative to buying the stock. Number two, and the point of our presentation tonight, is to gain leverage on high price stocks, or any price stocks really, but especially on the higher price stocks that are more difficult to go out and accumulate shares. By using less of our capital, of course, we also reduce risk. So those are the objectives of buying a call option. To help you out, we have our table here that lays out the 4 building blocks of option trading. So on the left here, we have calls and puts. These are the 2 types of options that exist. There are call options and put options. And there are 2 things that you can do. You can buy or you can sell calls and puts. Right? So you can go out and buy a call option, which gives you the right to buy 100 shares of a stock at a certain price by a certain date. If you sell a call option, you are obligated to provide that stock. You get paid for selling the call, but you take on obligations. And it's the same thing with put options. If you buy a put option, you have the right to sell an underlying stock at a certain price by a certain date. And of course, you can sell a put option where you are obligated to buy a stock at a certain price by a certain date. Remember, an option is a contract with strictly defined terms and conditions. We're going to talk more about that in a moment, but just understand as well on our calls and puts, whether we're buying or selling, we do have both bullish and bearish trades. So understand that when you buy a call option, knowing that the value of that call option will rise as the value of the underlying stock rises, that would make it a bullish trade. Also, if we sell a put, it becomes a bullish trade. And on the bearish side, if you buy a put or sell a call, these are bearish trades. But for our purposes in this presentation, I want to focus on buying a call option to illustrate the power of leverage. Now, one way I think that can help you understand options is by comparing it to something you most likely already know, specifically buying a stock. Okay, not an option in this example, just buying a stock. Now, here's a graph of Apple, and it's a theoretical trade. Disregard the dates or the price of the stock. It could be any stock. It's the illustration or the concept that I want you to take away. So at this stage, Apple is trading at $130 per share. I'm rounding that up just a touch. Now, it would cost $13,000 to buy 100 shares of Apple. Now, if we look at our buy stocks long example, what we like to call the what if table, on the left is the stock price, and next is the initial cost of 100 shares of a stock at $130 per share. Now, we determined Apple was trading at 130. That would be our initial cost. We can show on our table what would happen if the stock moves up or down. So if we were to sell our 100 shares of Apple at $130, we see that our profit or loss would be zero, right? We would break even on the trade. If the stock were to fall 5 points down to 125, we would lose 500. Down to 120, we'd lose 1,000, and so on and so forth. Now, what if the stock moves up? Well, our 100 shares, if the stock moved up 5 points, would be worth $13,500, and our profit would be 500. And of course, if it went to 140, the position would be worth 14,000, and we'd have $1,000 profit. Again, so on and so forth. Now, what is our max profit? Well, it's unlimited, because Apple can keep going to what we like to call infinity and beyond. Our maximum risk, of course, is the initial cost that we paid. So I think it's important to start with that as a foundation before beginning to discuss options. So let's discuss what it would look like as an options trade, and in this case specifically buying a call option. So if we're bullish on Apple and our underlying bias on the overall market is bullish, and Apple is trading at $130, we could go out and buy the right to buy Apple at $130 as opposed to actually buying the stock itself. Okay, so we're buying the right to do that. So we'd go out and we'd buy one call option. That call option gives me the right to buy for one contract 100 shares of Apple at a certain price, which is $130 per share, by a certain date, which is the expiration date. Again, it's a contract with strictly defined terms and conditions, and these are those terms and conditions. In this case, by the way, the expiration date would be out at least 60 days to the April expiration is the example we're going to use. Now, on that date, the cost of one contract for the 130 strike for Apple was $365 or $3.65 per share. That happened to be the price on that particular date. Now let's take a look at our same what if chart using a buying a call example. This is the stock price, so this is what would theoretically happen if the stock moves. We determined our initial cost of one contract for Apple would be $365. So let's take a look. If the stock at expiration of your option were to close at $130 per share, our option value would be zero and we would lose our initial investment. The same is true no matter where the stock went. If it was at 130 or below, we would lose. That's the most we could lose, our initial investment. What if Apple went to 135? Well, the intrinsic value at expiration of our call option would be 5 points or $5, which would give the option a value of $500, which means my profit at that point would be 135. That's 500 minus my initial cost would leave me a profit of 135. If the stock were to go to 140 at expiration, we see the value would be 1,000. Again, that's 10 points. Less the premium paid would give me a profit of 635. Now, just like owning the stock, my max profit is unlimited. But here our maximum risk is always going to be the initial cost, in this case, $365. So what does this mean for the investor? Well, let's take a look. On February 6th, again, now we'll use the actual price of Apple, was trading at 129.73, again, to set up a theoretical trade here. Stock's trading at 129.73, and had you bought the stock, just less than a month later, Apple had risen to 139.79. And for a purchase of 100 shares on the stock, you'd have a 7.7% increase or return on your investment, which is great, right? That's a wonderful return on investment in less than a month on a good quality stock. Let's go ahead though and compare the Apple trade of owning the stock versus owning the call option. So if I own 100 shares of Apple at 129.73, my initial cost is $12,973. On March 1st, we said the value of the stock was 139.79 is where Apple was trading, which puts the value of my position at 13,979. Our net profit at that point is $1,006 and that 7.7% gain I talked about. Now let's compare that to buying one contract at the $365 initial cost. On March 1st, the value of that option per share was $10.80, or for one contract worth $1,080. Our net profit on March 1st wasn't quite the $1,000 that the stock would have gotten us, but $715 was our value as of March 1st. And then here is the power of leverage. The percent gain on our $365 is 195%. Now we'll put a couple of more what ifs. What if you had gone out and were comfortable enough and confident enough to buy 3 contracts, let's say, would have cost you about $1,100 in your initial cost. The value would have been $3,240, a $2,100 net profit, also 195% return. And then when you get real confident, what if you had gone out and bought 10 contracts to control 1,000 shares of Apple? Still would have cost you just $36.50. That is a fraction of the $13,000 here. Would have put the value of the position at $10,800, the $7,100 profit. So that's a theoretical look back to convey and illustrate the power of leverage. What I'd like to do now is walk through a current case study on a position that I can share as a live simulation. So to be successful buying calls or trading options at all, buying puts or buying calls, we have to know the best time, in this case, to buy calls. And so for our illustration, I'm going to use our DEW timing system, which went to an up situation back on November 3rd of this year. So the DEW up system, which is one of our prudent timing system that gives us a great signal to see when we're coming off of a market bottom. We can see relative timing, the buy-sell ratio, the MTI had bottomed out, begun to rise, and we got confirmation from the DEW on 11/3 of 2020. And so we'll use that as our trade date. And what I'd like to do now is come into our VectorVest Options Pro software for the purpose of illustrating on a risk graph this actual live simulated trade. As you can see, it's trading right now. I'm using Tesla as our example. Stock's currently trading at $613, down today, but this live simulation of the trade shows us the power of leverage. And here we went out and bought one call option with a January 15th expiration, again using 11/3 of this year as our trade date. So we've given ourselves enough time to be right on the movement of the stock. At the time, on 11/23, the stock closed right around $423 per share on November the 3rd. So using the proper trading techniques, we went out and bought a slightly in the money call option with a $420 strike price. Now that call option costs $53 per share, or $5,300 as you see here as our max risk. That's our initial investment. The current price of that option is at almost $203 per share right now, and you can see again on the risk graph, this is live, we're up, I'm going to call it $15,000. That's the profit on the trade, which calculates out to about a 290% return on my investment in just about 5 weeks at this point. Now, again, to illustrate how powerful that is, a great function in the Options Pro is that I can compare these spreads to other trades. So I'm first going to use, if we were long Tesla on November the 3rd and we were to go out and have bought Tesla at $423, on that same trade date as the call option, we would have paid, again, roughly $423. I'm rounding that just a bit. If I break this down, we can compare the two. As of right now, I'm going to round up to a $2,500 profit Had I gone out and used the same roughly, between 5,000 and 5,500, in this case, to buy 13 shares of the stock, would have cost me $54.99, which is right around the price it would have cost to buy one call option to control 100 shares of the stock. So that profit is about $2,500, which would calculate into roughly a 48, maybe 49% return on my investment. Again, which is great, but a fraction of what I achieved using the leverage of call options. So that's comparing the same size, basically, investment of the two. What I'd like to do now is go ahead and illustrate what it would look like if you had simply gone out and bought 100 shares of Tesla at that time. Again, I'm using $423 as the price. Now that would have turned out well for you. You've got 19,000. The stock took off, and you would have been up 19 grand, which calculates again out to about a 48-49% return on investment, give or take, as it moves. But as you can see, your capital outlay and thus your max risk is at $42,300 versus the $5,300 that was spent on the option. And so yes, we've got about $4,000 more in profit for this particular trade, but remember, this is still around a 292% return on my initial investment versus the 48 or 49% return. So again, understanding leverage and understanding how to buy calls, and of course there's a whole nother side of it with buying put options to protect your portfolio or to profit in a downtrending market. I wanted to focus on the call option and use a higher price stock to show you how you can go out and profit on these higher price stocks using the power of leverage. So if you're interested in learning more about the power of leverage and learning how to build a system that will determine your option success so that you know how to first place a trade like the Tesla trade we just showed, how to align that with market direction, finding the right stock, finding the right option, and then managing that trade once you've placed it, I'd like to just take a moment and invite you to join me for the Options JumpStarter course, 6 weeks to profitable options trading. It's a complete step-by-step system that shows you how to buy calls and puts to profit in both up and down markets. We'll take you by the hand and guide you through the exact step-by-step option profit system that you need so that you can leverage your money with options. Now, the outcomes of the course is that in the next 6 weeks, you'll be able to confidently find, set up, and manage the right option trade at the right time to make money whether the market's going up or down. So if you're new to options or have struggled with them in the past, I believe this is the course for you. We put the course together for people who want a system to trade options the right way. So you can go to www.vectorvest.com/jumpstart to learn more about the course and to sign up if you choose to. Just know that after the course is over, if you show you've done the work and you're still not satisfied, we will gladly give you a refund. They say there's no such thing as a risk-free trade. When you hit the enter button, of course, any trade you do has risk to it. I like to call this a risk-free trade for the course. Again, vectorvest.com/jumpstart. There are some bonuses that'll come along with it if you choose the mastery package. We have a bonus module that will talk about covered calls for income. We'll show you how to consistently generate income every week. And again, if you choose the mastery package, you'll also have access to our mastery support sessions. So in the VectorVest University, you'll have access to those modules I just showed. And then every Wednesday morning at 11 a.m. Eastern Time, starting on December 23rd, we'll have a live session. We'll help you implement what you learned in the module, look at what you're doing and help guide you. And if you can't make the live session, don't worry. You can submit questions through a dedicated email bin, and we will archive that each day's recording and put it into our digital course. So again, go to www.vectorvest.com/jumpstart, and it will take you to the registration page. And so if you're looking to employ the power of leverage, I look forward to seeing you in our Options JumpStarter course. Thank you for taking the time. Please stay safe, stay healthy, and we'll see you next time.